identifying what that number is, making sure that you've got the right float in your account, figuring out how much you need to pay yourself each and every week from your savings, and then whatever happens with your income, assuming that it does come in and there's just an issue with timing and an amount, you should be able to cover yourself quite nicely and not really feel the impact per se of the variableness of your income changing.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again on another 360 Money Matters podcast.
Andrew, we're recording on a Friday. You put
always a good day on a Friday.
It's always a good day on a Friday, and I know you've put a lot of time, effort, and energy in preparing for this topic as well too, in terms of what we're going to talk to our listeners and our viewers about.
Well, this is one that I really like. No, I mean it's a bit left of center, so it's not something that you always come across, but when you do, it's not an easy one to manage. So now that we've built it up a little bit, Bills, what are we talking about?
Just before we do, there's been hours and hours and hours of prep work for this, Andrew. So I know how much time, effort and energy that you've put into this. So let's just rip into it. Let's rip the band off.
Billy's been sarcastic because we probably spend way too little time preparing for these podcasts. Like we put in maybe 15 minutes worth of notes into the show notes, and then we just turn on the camera and let the good times roll.
I wouldn't diminish the fact. No, on a serious note, this is like a public service announcement. On a serious note, we are subject matter experts in terms of what we're talking about, so we can afford to do that.
Yeah.
Anyway, let's move on because this thing is going to go sideways really quickly. We're talking to the eternal optimist in me, but we're talking to everybody about today in terms of how you think about and manage your cash flow if you've got irregular income. So if you think that you're in, a sales role with a high variability of your income being variable, you work part-time, you work sporadic hours, how do we think about that? Because
you earn penalty rates, self-employed, there's so many people that don't have the same regularity of income all of the time.
And thinking through that, what are some of the things and the strategies that you can deploy in order to try and manage your finances in an optimal way while you are experiencing, changes in your income?
Yeah. And it can be a really challenging one to manage depending on how irregular it is. I mean, some self-employed clients, they don't necessarily pay themselves a wage. They take dividends out of the business, and if the money isn't there, and if it's a business where you don't have regularity of income coming in and it might be bigger lump sums, they'll just pull out, lump sums, and it can be really, really challenging. And particularly if you get yourself into a poor position, because what a lot of people do to manage this, which I think is probably the worst thing you could possibly do, is manage it with credit card debt. But if you do get yourself into that position where you're in credit card debt because, your income's dipped below for a period of time and your thought is, okay, that's okay, I'm going to get that bonus, or, the income's going to come in from the business, or something's going to happen, it can be really difficult to get out of it, because if it doesn't happen the way that you expect it, you're all of a sudden now needing to manage credit card debt, personal loan debt, and you've still got the same irregularity of income that you had previously. So making sure that you get this right at the beginning is I think the ultimate key.
Yeah, and just on the credit card one, because you're right, it is a common strategy that we see people deploy. This is probably even worse than if you've got regular income and you're spending on your credit card, because using credit gives you the ability to spend more than you earn. The theory that we're talking about is, in this instance, doing that with the expectation that it's just a timing issue with your income. Yeah. If you've got the flip side where you've got regular income, you overspend, at least you know what you're going to get in and then what you need to contribute to pay back your credit card. But in this instance, if that irregular income changes and it doesn't transpire the way that you expect, it actually can make that position worse. Yeah. So, I think the really big message in that one is the credit card strategy to try and manage this is probably the worst thing that you can do.
Yeah, absolutely. Absolutely. So what do you do, Bills? I mean, you don't take out a credit card. You've got irregular income. What are some of, because everyone's going to be different and everyone's strategy is going to be different depending on, what your circumstances are, how irregular, what the differences are, and, what works for you. But what are some of the strategies and things that people can think about?
Yeah, and this takes a little bit of thinking and a little bit of planning. So it's not like you're in this position, you'll be able to deploy this straight away. But from a basic conceptual perspective, trying to prevent you running out of money in between your pay cycles, whatever that cycle is, because if that's the case, that's when you do tend to look at alternatives that are probably the wrong thing to do. So looking at what your expenditure is between pay cycles, regardless of what your income is, and then somehow creating some sort of buffer, which we'll talk about shortly, in terms of using or having savings to be able to cover that period. And make sure that you've got enough in there. It's no different to some of the bucketing strategies that we talk about, but we'll get around to that shortly. But essentially, it's using your own resources and your own savings and structuring that in a particular way that it can ride you out during these periods of volatility with your income.
So concept number one, never, ever, ever spend money you don't have. And what I mean by that is money that is in your bank account, not a bonus that was promised by a manager, not, I've got this contract and someone's going to pay and my business is going to pay it. And so you never spend money that you don't have. And if you don't have the money, then you make sure that you're not spending anything more than that. And within this, having a savings buffer, I mean, you consider your rainy day fund, you consider your buffer account. It's important always. So whether you're receiving a regular income or not, it's always important to have that. But it's even more important when you've got an inconsistent or irregular income. So your savings buffer is, doubly more important in those circumstances.
Yeah, and if you think about it from a practical sense as well too, that buffer, identifying what that is probably more critical if your income is irregular because it needs to be higher, right? The line in the sand, your margin of error, I don't know, whatever you'd call it, I think needs to be higher because of that. So that's definitely one thing. But assuming that you can plan this out and get yourself into this position, I think identifying a regular amount that you pay yourself each and every, whatever it is, pay cycle, pick a number, week, fortnight, month, it's different for everybody, but pick a regular amount that you then pay yourself in order to run and operate your life. So that's probably the next part of the puzzle, or the next piece of the puzzle that I'd suggest that you do and identify, because if that's regular, then you can start creating this banking structure that will help you to navigate through these periods.
Yeah, so in other words, you're basically, let's say you've got irregular income coming into a bank account. What you're then doing is not spending out of that bank account, but actually moving money on a regular basis from that account into your spending account or into your other buckets within the strategy. So you're in essence paying yourself a wage.
Correct.
And turning an irregular income into regular income. And essentially what that does is it means that you've got, some reliability in terms of income, but the science in all of this is making sure that you're understating or that you're under transferring. So what I'm trying to say by this is, let's say you've got an irregular income with bonuses and commissions, and let's say that accounts to $120,000 a year. What you want to do is pay yourself an income, but for that income to not be $120,000 a year, because there's going to be periods where that's going to run out of money because you haven't gotten the bonuses or the commissions as yet. So you want to pay yourself, say, $100,000 a year, so that you're in essence being able to cover the months where there's no bonus, no commission. In those months, you're still receiving that same level of income and you can cover that shortfall of money. And what it's also doing is it's working as a really great savings mechanism because you're not spending all of your income, you're only spending a portion of your income, and so you're also capturing more of that surplus income in there as well.
I think that you've just created the business case for us to get a whiteboard, Andrew, because that would have been so much easier to explain.
So much easier.
If there was a whiteboard and we can draw it out. But I think you got your point, your message across.
And just before end of financial year as well, tax deductible expense, because we need it for the podcast. So to the ATO out there that's listening, it's necessary.
Well, we're never going to get sponsorship from the ATO. Maybe we can plug Officeworks.
Maybe.
And basically say go and spend money before the end of the financial year so you can claim it as a tax deduction.
Exactly right.
And then maybe we can get some sponsorship in case they want to try and, use up some of their marketing and advertising dollars before the end of the financial year. What do you reckon?
Exactly right, Bills.
Okay, let's get back on tracks. I think that ties in nicely to the bucketing strategy, our Cash Flow Bootcamp program that we've spoken about previously.
Yeah.
And I think it's even more imperative that the more variable your income and irregular your income is, not only in terms of the amount, but also in terms of timing about when you get paid. I think in terms of how you manage your money, you have to be even better at managing money because of that issue.
Yeah.
So you can take that, it can be an issue and it can absolutely plague you, and you can live sort of pay cycle or paycheck to paycheck, or you can get a bit of discipline around it, a bit of support, build a bucketing strategy, talk about, identifying what that number is, making sure that you've got the right float in your account, figuring out how much you need to pay yourself each and every week from your savings, and then whatever happens with your income, assuming that it does come in and there's just an issue with timing and an amount, you should be able to cover yourself quite nicely and not really feel the impact per se of the variableness of your income changing.
Yeah, absolutely. And so look, bucketing strategy, not going to go into the exact details of how to set that up, but because we've done that in the podcast in the past, so Cash Flow Bootcamp podcast, and maybe we'll double back to that in a future episode as well. But essentially, you're doing a budget. You're working out exactly what your expenses are. You're working your point of sale expenses, or your expenses that you're paying for at the counter. And live, all of your direct debit expenses, so everything that's happening automatically. Now, what that's designed to do is essentially turn something that's variable in nature, your expenses, into something that's quite predictable, and making sure that you're accounting for it each and every fortnight, week, month, however frequently you get paid. The difficulty with that is, okay, for someone who's earning a regular income, you've got regular income and irregular expenses. You then throw onto the fact that, okay, I've now got irregular income and irregular expenses. And so the complexities on both sides, having a strategy and managing your income and also your expenses it's way more important when you don't have that same regularity of income.
Yeah, and if you think about that, in terms of the cash flow strategies, and one of the things that I keep thinking about is travel, because I think that one in particular is on most people's list that we speak to. But in our strategies, when we're building the cash flow boot camps and building the bucketing strategy, one of the things that tends to appear in most of the strategies is an allocation for travel. And I'm just throwing back to what I've seen with people who have got irregular income. You're living paycheck to paycheck, and like everybody, we get to a certain stage and go, geez, a holiday would be nice. So once again, go and book it, but how do I pay for it? Credit card. Income maybe stops because you're taking time out, because you're on holidays, and it actually gets worse and worse and compounds, and then you're chasing your tail again. So I think, the call out here is find something to help you with your motivation, find something that resonates, because the discipline, I think, is definitely worth the prize at the end of it.
Yeah, exactly right. Exactly right. And you can see it. I mean, you build into this cash flow strategy all of the things that you want out of it. So if you want to go on a holiday every year, well, then great. You create a bucket for it. You put an amount of money, and you know that you're going to do that each and every single year, rather than, getting to the winter months. And I'm just saying that because it's starting to come into winter in Melbourne, and everyone tries to get out as soon as that starts happening.
Everyone heads north, right?
Yeah, exactly right. Yep. But rather than getting to, June and saying, hey, I really need a holiday, I really need to get out, and all of a sudden there's no money there to do it, or there's nothing that's been accounted for it. And so you're either, liquidating assets, or you're, doing it on credit, and further exacerbating that issue.
Yep. Andrew, let's change tact a little bit. if you're in a relationship with somebody and assuming that you're sharing your finances, one person's got irregular income, the other person maybe doesn't.
Yep.
I think that's probably a really optimal position to be in if that is how it pans out, because it does give you some options. What's our thinking around what that looks like?
Yeah, so some of the strategies that we've seen work is using the person who has regular income to cover all of your fixed expenses.
Mm-hmm.
You know, your mortgage, your rent, your things that you can't control, but you know you're gonna definitely need to pay. And then using the other person's income to fund lifestyle expenses, to fund all of your investment, to fund all of the other things that you don't necessarily have to have in order to survive, but all of the irregular expenses that way.
Yeah.
And so it does mean that it gives you that little bit of discretion that, hey, if income has come down, maybe you're going to reduce. I was going to say investment, but no, you don't reduce your investment.
It's the last thing.
You reduce the amount that's going toward the holiday fund, because whether that comes in this month or next month, unless you're going on holiday immediately, it doesn't ultimately matter that much. And so what you do is you use one person to cover all of the fixed expenses, the other person to cover all of the variable expenses, and manage it in that way.
Yeah, and I really like that idea as well too, because if you can stick to it and you've got the discipline, it actually means that you adjust your spending exactly and directly in line with that person's income.
Yep.
So I really like that idea.
It almost motivates you to earn more and do more and produce more as well inadvertently.
Well, it's like what we see now where people suffer from things like, call it lifestyle creep or whatever, where you're earning more and then you spend more, and then maybe your earnings go down, but your expectation in terms of your lifestyle is still up there.
Yeah.
If you can get it, it's like, what do they say? It's, if you get a pay increase or that, don't increase your lifestyle in line with it.
Yeah.
That's a bit of a rule of thumb that we've got. But yeah, I really like that idea, and I think that can work really, really well and be quite powerful as well too, for people that are in that position.
Yeah, and look, managing it is more difficult. So if you've got irregular income, there's no question about it that it means that it's more difficult to manage.
Mm-hmm.
But I would argue that it's actually more. It can be a hidden superpower. So you consider the fact that, okay, let's say you're earning a regular income and you're receiving bonuses and commissions. If you can essentially live your life as though bonuses and commissions don't exist, then anything that comes in via a bonus and a commission is a bonus, right? Pun intended.
I was wondering what word you were going to use there. Yep.
But anything that comes in, you don't need to account for it. That doesn't go towards your lifestyle, that doesn't go towards any of the expenses. And there's essentially cream on top that you can utilize for investment, that you can utilize for holidays, that you can utilize for all of the things that you don't necessarily need to account for on a month in, month out basis. So if you can manage it well, it can be incredibly powerful. Yeah. But if you don't manage it well, it can be incredibly detrimental.
Yeah. I'll give you a specific example of that, because you're right. I think there's a lot of benefit in this. But if you can achieve that, this is huge. And I'll give you an example. So client we've got, in a a sales role, commission-based role, fairly healthy base salary, and then based on performance targets, every quarter, a bonus gets paid. Same sort of thing. We've got them to a position where they're meeting all of their expenses, and this is everything, debt elimination, investing, you name it, in there as part of the base. They're fairly high income earners, these two members of a couple. And then every time the bonus comes in, we basically get together, have a meeting, and it's like, okay, what do we do with it? Because our lifestyle's taken care of. We've got the provisions in place. We've got a bucketing strategy. We've got, a provision for travel. We're ticking all of those boxes. We're regularly contributing to investments. So the bonus comes in, and it's like, okay, what do we do? And realistically, the question that we're trying to answer is, which needle do we move? So there's options. There's debt elimination. There's investing. There's some form of lifestyle, which is what we don't want to get to, but it's always there if it's a really big one. And I think it's important to celebrate your wins and stuff as well too, as long as you've got some discipline around it. But these things here move the needle. So if they get a really healthy bonus and decide, hey, we're going to take a lump sum chunk out of our mortgage, it moves the needle on their debt elimination strategy.
Yeah.
So it can work really, really well and really, really powerful.
And it's one of those things that we're really big advocates for is making decisions on your money. And that sounds really stupid because normally you think, of course, I'm making decisions on my money. But, how often do you get paid an extra $5,000, $10,000, $15,000 a year because your income increases and you haven't made any rational decisions around what you're doing with that money? It's just gone. You still save the same amount as what you were earning or as what you were when you were earning less. Making a decision on, hey, if it's going to go towards the lifestyle, I'm making the decision that it's actually going to impact my lifestyle.
That's where you get the value.
And that's where you're getting the value. So great. But it's all about making the rational decision around what you want to do with your money rather than just the decisions that, you don't think about and great, you've got an extra lunch a week. And really the impact of it is nothing in terms of your lifestyle. You don't think about it anymore. But being specific around what you do with the money, I think is far more powerful in the way that you want to be managing your cash flow and your money.
Yeah, no, Andrew, well said, well summarized. I think that the key message here is that if you are in a position where your income is irregular, there's a way to manage it, I think, effectively. We've seen that with dozens of clients that we've deployed this strategy to. So if that's the case, if you're in that position, feel free to reach out. We'd be more than happy to have a chat because there is a better way of doing it. And I think with a lot of the stuff that we talk about with people, the thing that I think talking about moving the needle the most in terms of how people feel is getting the control around the money management. All the other stuff's great, but we're usually talking sort of longer term stuff in nature. The future is going to be bright, but the one that moves the needle at least immediately and has the most felt impact at the start is getting your money management right. So there's definitely a way to do it optimally. And if you're in that position, we'd be more than happy to have a chat.
Yeah, absolutely. Thanks again for tuning in. Thanks, Bills, for another podcast, and thanks to our listeners and our viewers. And if you got some value out of that one, like, subscribe, and we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.